All right, let's jump right in. Today, we're going to unpack a theory that suggests the financial markets might not be the chaotic mess they seem to be. This is an explainer on the inner circle trader methodology, or ICT for short. It's a very specific lens for seeing how price really moves. You know that feeling, right? Where it seems like the market is personally playing a game with you. You see a perfect trend, you place your trade, and then, bam, the price just reverses and goes in the exact opposite direction. It's almost like it was waiting for you. It's an incredibly frustrating feeling, for sure. Well, according to the ICT theory, that feeling, it isn't just in your head. The common view is that the market is this chaotic game of tag, with millions of buyers and sellers all running around. But ICT proposes something totally different, that it's all a meticulously calculated plan, run by a computer. Not bad luck, but literally by design. So, what is this grand plan? This brings us to what ICT followers would call the market's big secret, the algorithm that they believe is hiding in plain sight, pulling all the strings and driving the price action we see every single day. So the foundational idea, which comes from ICT creator Michael Huddleston, is that what looks like random buying and selling to most of us is actually the output of a really sophisticated computer program. The theory goes that the big financial institutions, the smart money, they're not just participating in the market, they are actively directing it with an algorithm. Now, what's so interesting here is how this completely reframes everything. So instead of a chaotic, reactive system, I want you to think of this algorithm more like a GPS. It isn't just wandering aimlessly. It has a specific destination programmed into it, and its one job is to get the price there as efficiently as it can.
Okay, so if it's a GPS, it has to be going somewhere for a reason. What's the destination? And what's the fuel for the journey? This gets us to the core purpose of the algorithm, which is all about hunting for money.
So where exactly is this algorithm trying to go? What's its target? It's hunting for something called liquidity. Now, that can sound like a really complex financial term, but in this context, it's super simple. Liquidity is just money. To be specific, it's all the money sitting in the market in the form of stop-loss orders from regular traders like you and me. See, the big banks know exactly where these big pools of stop-losses are. They're typically just above old highs and just below old lows. The algorithm's job is to drive the price to these exact spots to trigger those orders and essentially raid them. Honestly, think of it like Pac-Man just systematically moving through the maze to gobble up all the coins. Okay, so if there's this giant, invisible force moving through the market, it's got to leave some evidence behind, right? Well, according to ICT, it absolutely does. You just have to know what kind of footprints you're looking for. The first, and probably the most obvious footprint, is something called displacement. Now, this isn't your average everyday candle on the chart. Nope, this is a huge, powerful, energetic candle that shows the price moving with incredible speed and force in one clear direction. It's basically a sign of institutional intention. And this analogy just illustrates it perfectly. Imagine an elephant jumping into a tiny little kiddie pool. You are not going to miss that splash, are you? It would be massive, violent, totally unmistakable. That splash, that is displacement. It's the market showing you in no uncertain terms that the elephant just made its move. Okay, so when that elephant makes such a giant splash, what does it leave behind? Well, a mess, right? An imbalance. In the market, that fast, violent move of displacement often leaves behind an empty space, a kind of inefficiency on the chart. ICT calls this a fair value gap, or FVG for short. Here's an easy way to think about it. Imagine you're painting a wall, but you're in a real hurry. Your brush moves so fast that it just misses a spot. Well, the algorithm, according to this theory, really doesn't like leaving those empty spots. So the market has this strong tendency to come back to that gap to repaint it, to fill it in, before it continues on its way.
So we know what to look for now, the big splash and the gap it leaves behind, but here's another critical piece to this whole puzzle. These things don't just happen at random times. Nope, they follow a very specific schedule.
And this is a really crucial point. The algorithm isn't running 24/7. Just like a business has its hours of operation, this program is designed to be most active during specific, high-volume parts of the day. So if you're out there looking for the elephant outside of these times, you're probably going to be waiting a very long time. ICT calls these specific time windows kill zones. The most important ones are typically during the London Open from around 2 to 5 a.m. Eastern Time, and then the New York Open from about 8 to 11 a.m. Eastern. This is supposedly when the algorithm is doing its heaviest work, hunting for all that liquidity. So when you start putting all these different pieces together, it's almost like you're putting on a new pair of glasses. The chart that used to look like a bunch of random noise starts to look like a structured, purposeful map. The whole approach, then, really boils down to 3 simple steps. First, you wait for the elephant's splash, that really clear displacement. Second, you spot the fair value gap it leaves in its wake. And third, you check the clock. You make sure it's all happening inside one of those key kill zones. And that right there is really the central idea. This whole methodology, it's not about predicting or guessing where the market's going to go next. It's a reactive model. It's all about patiently waiting for the smart money to show their hand, and then just following in their very large footprints. So whether you buy into it completely or just see it as a really interesting model, it definitely makes you think, doesn't it? After seeing the market through this lens, as a hunt for liquidity, driven by an elephant on a schedule, will you ever look at a price chart the same way again?